Hi, and welcome to the FXRate.com Beginner's Corner. To understand why and how a currency pair moves and so to be able to forecast price movements to attempt to profit from them, traders have to use certain tools. In this video, we will give you a general overview of those tools and the basic concepts involved. First of all, investors need to see price movements. In Forex, the price of each currency pair fluctuates on average 18,000 times per day. That's the number of times the last decimal in price changes on a daily basis. That does not mean a currency pair usually jumps 18,000 pips up or down in one day, but that the price fluctuates all day long, and by the end of the day it has been moving in a certain range, usually in between 80 and 200 pips, a total of 18,000 times. In this example, the euro-dollar has been moving in a range of 100 pips in one day, as it has been trading in between 141 and 142, right? In between the tools we can use to forecast market movements, there is technical analysis. And to talk about technical analysis, we need to do a bit of history, right? Back in 1884, Charles Dow created two averages or indexes for the stock market. These indexes were called Dow Jones Industrial Average for the industrial sector and Dow Jones Transport Average for the transport sector. With these indexes, he pretended to measure the market as a whole rather than simply focusing on individual stocks. He wanted to make these averages the foundation of a comprehensive theory that could be used to explain and predict general market movements. Using this index, he developed his theory, the base of all modern technical analysis. And indeed he succeeded, as of today, investors continue basing their analysis on his status. In fact, all that we apply today in Forex market is based on what Mr. Dow prepared and studied back in 1884. So, we call technical analysis the study of past market activity using graphic tools usually known as charts, right? In order to predict future movements in that particular market. Technical analysis is then based on charts and be aware past market activity. That does not warranty future movements, but helps to determine the mathematical hopes of success in future trades. A chart is a drawing or graphical representation of quotations of stocks, bonds, currencies, or any other financial asset reflected by the market. The evolution of price is placed in the vertical axis of the graph and in the horizontal axis the temporal dimension such as day, hour, minutes, etc. Now let's introduce another concept. Technical indicators or oscillators are graphical representations of a mathematical relationship between the different variables the charts show. The advantage of these indicators is that they are easy to use and understand and of high reliability when a decision must be taken. Easy to read, the buy and sell signals are clear and concrete, and that's why all financial assets should be analyzed with these technical analysis tools. So that you see how it looks like, here is an euro-dollar monthly chart. As you can see, the black line that moves all across the chart is the price action, while the blue horizontal lines are called Fibonacci retracements. In this case, just one of those technical indicators mentioned. Now on, where to start? Well, these days, almost all brokers around the world offer charts inside their trading platforms, right? And one of the most popular is called MetaTrader. MetaTrader is popular because it has the advantage of being an open software that lets the user develop his own trading tools. Since its creation, thousands of such tools have been created and shared around the world. On FXRate.com, there is a full section dedicated to MetaTrader. You can find there those tools, tips, and reviews, okay? So, once you have your chart, you will see something like this for each currency pair. First of all, you're going to see these price representations called candle, where you can see for a certain period of time what happened with price, where the price opened, where the price closed, was the high reach, was the low reach, and in when it comes to the color of the body, you will see if it has been a positive movement or a negative movement of the certain pair under study. So your chart will be looking something like this. This is an euro-dollar daily chart where each candle represents one day. Blue candles represent days where the pair has been rising, while the red candles represents days where the pair has been falling. I have also added two different technical indicators, so you can see that some of them are plotted inside the chart, while others are plotted in a separate chart just below the main one, okay? However, not only technical analysis is valid to forecast market movements, right? A good number of traders base their trading decisions in what we call fundamental analysis. Fundamental analysis is just the interpretation of macroeconomic data as of how it will affect a certain economy and so the currency of that economy. This data includes, for example, the study of the gross domestic product, the employment conditions, inflation, production, consumption, etc. As an example, if a certain country sees a strong increase in unemployment, we understand that as bad for the economy, right? And so that particular currency should weaken against other currencies. Most of this data is published on a monthly basis and press schedule. That makes of an economic calendar a basic trading tool. As you can see, fxrate.com also has a fundamental calendar where you can see all the events scheduled day by day, hour by hour, adding three main readings. Previous readings represents the previous number, previous month, previous quarter, or previous year reading, right? Consensus represents what the market is waiting for on current reading, right? And actual is in fact the number released at the time of trading, okay? Of course, all of this is not as easy as it sounds. Despite each major economy publishes an average of 5 macroeconomic numbers per day, not all of them weigh on the price of the currencies. Besides, one single negative macroeconomic data can hardly affect a currency. However, a series of negative readings in time will of course weaken the currency, as investors won't be willing to buy it, expecting that particular currency to start losing value as time goes by. As an example, a bad number on retail sales a certain month does not mean the economy of a country is paralyzed, right? However, several months in a row of showing a continuing decrease means that little by little people are buying less goods and services, and that indicates that the economy is shrinking, and that is understood as negative for the economy, okay? These macroeconomic readings are usually qualified according to how strong the impact in market will be. Economic data considering of high impact could trigger movements from anywhere between 30 and 200 pips in less than 1 hour, depending on the currency pair under study, right? While low impact readings will probably be ignored by investors at the time of publishing. Remember, if there is a series of negative numbers of low impact data, it's also understood as a sign that the economy is not in very good shape, and that will tend to weaken the currency of that country or region. Fundamental data are not only those pre-scheduled macroeconomic numbers, right? There are also external factors that can affect an economy and as a consequence the value of its currency. If you want to know more about this, check our next video.